When you're starting to sell into retail, taking it from a B2C model, a business to consumer, into a B2B, business to business, you want to know when you're going to get paid, because you're putting product out there. Most of the time with consumers, you get paid up front. You go to a weekend market, you give them something, they give you money, transaction's done. With online, sometimes there's a delay, 2-week delay, 30-day, whether until it hits your bank. But with businesses, it varies. So initially, when you're selling into independent retail, typically when you need to get those initial retail stores, you have to put it out there on consignment because nobody knows about the product. Nobody knows, you have to convince them to purchase the product or to bring it into their store even. So it starts off with putting out 6, 12 units on consignment, having it sell through, and once it sells through, then they pay you. You gotta go frequently back in and check on it, which is an opportunity to educate them more about the product. Second step after that, once you get the sale into the store, is they're gonna pay you, whether that be paid up front, which is preferable, or paid on terms. And terms mean how far in the future are you gonna be paid for the product that you deliver today. So if I bring in product and it's a net 30, they're gonna pay me the remainder 30 days after I deliver the product. And it goes the same for distributors, it goes the same for if you sell to Walmart. Usually those terms go higher and higher. But that's a point of negotiation. That's something that you need to negotiate in and be aware of on the front end, that you may not get paid when you deliver product, and that's typical with this business. It also gives you a lot of flexibility because you can also factor that you can have people take that risk and pay you less cash up front than they're going to receive in the future. And by doing that, you'll be able to get that cash flow that you need to invest in your business now instead of waiting on the payment. But also there's risks on the back end to putting out product on term. When working with larger companies, sometimes if it doesn't sell through by the end of the term, they'll return the product to you, charging you for the return product as far as logistics, and having you discount that off of the sold product. That might be in their 50-page contract that they send you. Also, having a term out there means that you can't be investing in the next round of inventory. So you might have $1 million of inventory out and you haven't been paid for that, so you can't put the money into the purchasing of new inventory to come in. And if you get that wrong, if you get that step wrong, you could hit a dry spot where you're not fulfilling on obligations as far as delivery. And that could drop you from accounts, that could give you a lot of problems. And with larger retailers, there's a lot of penalties involved. So they will penalize you for not delivering on time, not delivering what was ordered, etc. So it's something to be aware of on the front end. It's important to grow small, to be well funded, to have that funding already set up before you get to those steps. And you might want to look into that beforehand so that when you get to that level, you'll be well prepared for any kind of success that you're going to be seeing.